live now. All right. So,
All right.
Amar, start with your disclosure, would you please?
Well, yeah, I have to get that up. Hold on.
Okay. All right, folks. So we are live and in person on YouTube. If with Amar and me, he's going to get his disclosure up. And thank you for joining us, my friends. If you are here, we're trying to do this, like I said, every other week or so. Let me pop out that one just a second, Amar. Got to get situated here, my friend. There we go. So
do you want me to say it play right now?
Can you hear me, Amar?
Yep.
Amar.
Yeah.
I can't hear you.
Can you hear me? It says it's coming across.
Hey, Al Buckner. Why is it muted? All right, so it looks like you're muted for some reason. Why? No, unmute. All right, Mark, say something.
Hey.
I still can't hear you.
Yeah, it says unmuted on my side.
What happened to your... I can't hear you, man.
You can't hear me at all?
That is weird. All right, hold on a second, guys. We're going to... Sharon says she can hear us both. Okay.
Yeah, it says it's unmuted.
All right, cool. Amar, say I can't hear you. That is okay. Yeah, they can hear us both. All right, fantastic. Amar, who's your favorite football team?
I guess I'm a Ravens fan now.
Did y'all hear him say the Patriots were his favorite football team? Man, that is weird. I can't hear you. No thanks. I got 17 people on here.
You want to log out and log back in?
Football team? There you go. That is weird. I can't hear you. All right, I got it. I got it now. Sweet. All right, cool. I'm good. Amar, you're still there, right?
I'm just doing my disclosures right now,
yep.
Josh.
Go ahead. Right on. I got it.
Thank you for listening to the Savvy Wealth Podcast. Click the subscribe button below to be notified when new episodes become available. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember, investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Client First Capital, LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Client First Capital, LLC and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Client First Capital, LLC unless a client service agreement is in place.
Is that it?
That's it.
All right. For the love of me, I hate those flipping. I hate those things. All right. So Amar, let's talk. Hey, Mike, we got Webster, New York. We got Pure, Michigan. All right, Myrtle Beach. Right on. Forgot where Don's coming from. I think Don is coming from. Mark says go Seahawks. Let's start first and foremost. I think, Amar, that kind of what we do with clients. We've got this question a couple times, my friends. Like, how does Amar do differently than Josh and whatnot? And I just, for any of you all are considering like hiring a financial advisor and wondering, the difference between Amar and me. I'll just start with me. I'm very hands off. And so what that means is that some folks like, we got North Carolina right on. Some folks, they love Vanguard. They love being self-directed. They just want to make sure that their compass is still aligned with the azimuth they did in their land nav. So they're like pointing a 90-degree, they want to keep following that. They don't want to veer too much. And they say, hey, Josh, I'm worried about the taxes. I'm worried about this, but I don't need any hand holding or anything like that. I just need someone to kind of kick me in the butt if I need it, or to kind of confirm that I'm good to go. That's what I do. And then what happens is once a year after that, like I was talking with a guy today, he pays the full-fledged financial plan. And then once a year, he pays me $500 or twice a year, whatever he wants to do to kind of review, just make sure he's still tracking, that he's not too far off, but he's doing it all himself. He's bringing his money to Schwab. He's going to the intelligent portfolio over there. And that's how I work with clients. And Amar works differently, but I just want to stress this. We do not get any quid pro quo. I do not get money from Amar. Amar doesn't get money from me. We do these YouTube videos because I think they're helpful to people from not just my perspective, but from another perspective as well. And, Amar will be jumping on here every couple of weeks or something like that, just kind of go over things. So Amar, tell them a little bit about what you do, if you would.
Yeah, absolutely. So, I'm like your traditional advisor in the sense that, well, let me back up and say one thing. Josh and I have known each other since 2011, right? So like we're long-term friends and we're trying to help each other out, and more Josh is helping me out than vice versa. But I live at the intersection of values, core principles, your family dynamics, and your wealth. And we're trying to integrate the three to make better decision making, which leads to better lifestyle, better values-based living. And we do that through financial planning, investment planning, income tax planning, and estate planning. So integrating all those different approaches and making sure your dollars, your time is spent on things that you value will ultimately give you a better retirement or a happier retirement. And so I am more hands-on, I would say. So like I have less than 50 relationships. So my goal is to work with a few families, but really be deeply integrated in terms of helping them get from point A to point B. And, my big thing is, and I think Josh, we should highlight this, is that, we both have created products that we're comfortable with our own family having, and we've done it in ways to save the end user or end client costs. So Josh and I are not doing dinner seminars, which you probably get in the mail.
Yes.
Come to a dinner and we'll teach you about retirement planning or estate planning. I mean, those things cost a lot of money. And to give you an example, to do them on a consistent basis, you need to invest $25,000 to $50,000 of clients' monies, right? These are like fees that we get, and then we turn around and we try to grow the business. So we're not doing any expensive marketing. YouTube is essentially free. It's just time and putting out good content. And both Josh and I work out of our houses, so we don't have any fancy offices overlooking the ocean or anything like that. We're trying to do this in a way that saves the end user costs, right? So we're trying to be cognizant of costs, taxes, and making sure that you get an efficient and simple solution. It would be the last piece, is that I think, Josh, both you and I are not going to analyze a private equity fund or a hedge fund because we both don't agree with them. And so there's a number of studies.
Pain in my head to even think about that, to be honest with you.
Yeah. And, some of these funds are 2 and 20. And so we're looking for something that we're focused on simplicity and looking for something that we can stay the course, not only one generation, but maybe multiple generations, if that made sense.
No, right on. Absolutely. So if you could, guys, Amar, you started a relatively new YouTube channel. But if you go sign or subscribe to his YouTube channel, we'll put it in the show notes, because once you get 100 subscribers, you can actually have your own, youtube.com/heritage wealth planning. And Amar would like to be able to get youtube.com/client first cap.
That's the goal. So the channel is called Savvy Wealth Advice.
Okay, Savvy Wealth Advice.
And I can share my screen.
Oh yeah, please.
See what the logo looks like. Hold on. So can you see my screen there, Josh?
Yep.
Yeah. So as you can see, I only have 3 subscribers right now. I need to grow that to get to 100. So I appreciate anybody that logs in. And I've started, like Josh said, I'm new. So like maybe 2 weeks ago was my first video here. But like I've done a couple of videos, and these are good videos, kind of like, if you have blended families, like some of the family dynamic conversations that you need to have. Oops, I just hit play. But you get what I have there.
Hey, Amar, I had a guy actually email me yesterday. He's asking about me giving him not testimonials but referrals, and I won't do that. I don't. Do you have a thought on? I don't even know if you can. So he's like, hey, can you refer to me some people you worked with in his neck of the woods? And I'm not going to do that. I don't even know if you can. Do you know? Can you even? I don't even know if you can do that. If someone says, Amar, I want to work with you, but I want to make sure you're not a scumbag, so I want to give. I would like to talk to two of your clients.
So I can't have published testimonials. Now, FINRA and SEC, they're looking at this to modernize their rules. But
Right.
as of right now, I can't have published testimonials. But more than happy to have any of my clients reach out and to talk about their experience. Most of my clients I've worked with for, I would say, 4 to 8 years.
Okay.
All my current clients have been clients for 4 to 8 years.
So you can actually say, if someone says, hey, Amar, I'd like to get a referral, whatever it's called, you can do that.
Yeah, I can have one of my clients call somebody and say, hey, this has been our experience with Amar. Good, bad, or different.
We got a question on here. Is that Don says, in his 401k has a money fund available currently yielding 2.1 Amar. Would it be wise to take some of the profit from the other allocations and move it to a cash position for now? That might be something that you'd have a hard time answering just because of the nature of the business. But
2.1 seems really good.
Yeah, me too. That's what I thought too.
We look at the T-bill rates and everything else like that. And actually, I have a rate sheet that I can bring up.
Yeah, please.
Yeah, let me grab it.
Actually, because I want to talk, but if you also answer while you're bringing up your stuff from you custody with Schwab, or who you custody with?
Yeah, so that's another thing. I custody with Schwab and Fidelity. So,
okay. So if you have, is there any indices that are down for the year that we can do tax loss harvesting? We're going to talk about the 10 things people can do, but are there anything out there that's down that we can sell to take some losses?
Yeah, wait, so let me do one, let me just get this piece up here. So I'm trying to find
so while you're doing that, Don, so if you're getting 2.1% in the money market, it's probably like a stable value fund of some sort, or a guaranteed investment contract, which I'm a fan of, actually. Now, the 10-year treasury right now is paying 1.759, as we see there. So if you're getting 2.1 in a liquid account relative to the 10-year treasury, that's tough to overlook. Now, John just subscribed to you, Amar.
Thank you.
Thanks, John. Much obliged, man.
So here's a rate sheet. This is as of 11/20, right? So today, and you can see what the average. So for a AAA corporate right now, if we look at a 1-year rate, that's 1.57. You can get U.S. Treasury 0 at 1.59. So you can see to get to something, I mean, that's definitely.
You're going out to 20-year zeros. You're getting 20-year treasuries paying 2.04. Then you get zero.
Yeah, but and the end user, I believe most of these 401k funds in the stable fund, once you put money in, you can only take 1/12 out of it out. So you got to look into the actual 401k in the stable value fund. It's not like a money market where for most firms where you can put money in and take all the money out. You have to drip out of it. It's one of the hurdles that you may see. But so let me get the article up for today. What do you think, Josh?
Yeah, absolutely. Unshare your screen while you're going through that, if you would.
Okay, sorry.
Thanks. All right, so while you're doing that, I got people who like the Ravens, Saints, and Seahawks, my 3 worst favorite teams on here, who are saying, go Saints, go Ravens, go Seahawks. Freaking nuts, dude. Oh, can't stand the Saints, can't stand the Seahawks, can't stand the freaking the Ravens. Oh. And then we did get someone who likes the 49ers, the San Jose 49ers. It's all good. It's all good. Anyway, so just while Mars bringing that up, the interesting, going back to you, Don, is that the old, yeah, right here, this lady putting her pen in her mouth. Should you go to a cash position more, take some profits off the table? I just did an article today or a video this morning where I brought up my man Brian Westbury from First Trust Advisors, and his thing is, it's still a bullish market, and they actually increased their S&P 500 from 3,100 at the beginning of the year to 3,250 by the end of the year. So they're bullish, and it gives you a bunch of reasons to be bullish.
But it's kind of funny how these analysts are upgrading their positions. So in the beginning of 2019, the S&P 500 was supposed to be, if you take the average of all the analysts out there, was between 2,950 and 3,000, right? That was the average. And we've had decreasing earnings, and they're increasing the expected returns. I would tell people that nobody has a crystal ball, and there's a good argument for the market to go down. There's a good argument for the market to go up. It's just, I mean, there's no crystal ball.
No, but what this guy's saying, he was saying even last year he expected the S&P to be at 3,100, and he just So yeah, that's what I'm saying. It's pretty interesting. The point about that is he's a bull. I mean, he's a bullish guy. And so then you see another guy as a bearish guy, and you find all these reasons to capitulate. That's the issue. I don't know, to take cash. I mean, but here's the interesting thing, Amar. Since the Christmas Eve, all right, so we had the massacre last quarter from the beginning of October till Christmas Eve, where we had bear market. The S&P 500 with dividends included is up 35% from last year until now. Who knows? But I just sit there and I think, man, if you missed out on that because you're sure that there's a recession or the inversion or the repo market, that's sad, man, because that's where it's time in the market, not market timing. You know what I'm saying? And I just feel bad for all these people who follow not just the naysayers, but Obama or Trump or Elizabeth Warren. And it's too bad, because that's a lot of money you left on the table for sure.
I think JP Morgan came out with this piece. It outlines, it's like a table, in the first row or the first column, it has the economist's name, it has the date, what they said.
Yeah.
And the very last column is how much the market has gone up.
Wow, that's awesome.
time.
Yeah.
So if I find that, I'll definitely send it out or post it on here so that people can see that.
Advisor Perspectives has something like that, where they say Jeff Gundlach or something like that. Yeah, you know what I'm talking about? They said he is the most negative Nelly out there, and they showed like same kind of thing. It was, I'm sure it was a cut right off the JP Morgan thing. It's exactly what you taught. It was interesting as all could be. I said, man, that's fantastic. So let's read about this lady here with the 10 top year tax tips. Now, Amar, I did a video on this earlier about a week ago after you sent it to me. But I want to kind of hear your perspective too, that we can bounce it around. So let's go down to see what
let's go through this. So like
right here,
first thing is 401k and HSA contributions.
Well, scroll up a little bit where you can see the bullet points. We don't need to hear Mary. Yeah, there we go. Let's just read off. We don't need to hear what her take is, but go into the first one. Make 401k.
Yeah, so 401k. I mean, this is great. If you're in tax planning, is making sure that you fully contributed to 401ks. We talked in another video about after tax contributions in a 401k. This is the time to get heavy on those. The other one's HSAs. And I think HSAs are great because you can put pre-tax money in. You can grow an HSA. I think S&P 500 is almost in every single one of the HSAs as an investment option. And then in retirement, you can pull from your HSA pre-tax for medical expenses. So it's probably the best thing that's out there all around. Now, the caps on it are pretty low, right? So, you're not going to be able to put, I think the cap is 7,200 or so in there for a family, and 5,500 for an individual. So not like the 401k, but making sure that you maximize these out.
Maybe. There's a lot more that just goes into maxing 401ks out, you got to look at the back end. And this is my concern. I think a lot of people by default now maximize the 401k up to your employer contribution. Absolutely maximize it. If you have a Roth 401k, sure, without question. But don't just follow the tried, if not necessarily true anymore, by saying, I can put, well, I don't even know what the max is anymore, Mark, 25,000 if you're over 50 or something like that.
Yeah.
I just, so I was working with this guy today, this morning, and we're just looking at the widow's tax trap. And he's 10 years her senior, and she's going to get flipping hammered when he dies. And this is the issue with these pre-tax. And another issue that goes with the Secure Act and redoing the RMD tables, it creates this false sense of, I'm deferring taxes, I'm doing good. And I'm sitting there thinking, not necessarily. So
so we should identify when it says make 401k contributions, this is not solely in the pre-tax bucket. This could be in the Roth or after tax.
Let's see what she says. Go down and see if she does say tax, because she says tax deductible contributions. I think she doesn't mention the Roth. So I think for you and I, Amar, we're saying yes.
For our discussion.
Absolutely. But this again, where you gotta, I think you can't just follow the mainstream financial media, because a lot of these guys are friggin' dumb as nails. They just don't know what the hell they're talking about. And that's me saying that, Amar. All right, so but we both agree that HSAs are the freaking way to go. 401k, yes. If you don't have a 401k or a 401k match, you got to see where your tax brackets are.
So based off of your tax brackets, you can determine to do pre-tax, Roth or post-tax. And so you're one thing that we should highlight, it's based off of what your situation is.
Exactly.
Right. It's not blindly put into the pre-tax. No, and if you don't have access to a 401k, you can still do like an IRA, right? Up to a certain amount. You could also do, like, if you have a small business, you have access to a solo 401k, SEP IRA, simple IRA. So not just specifically 401ks. They should have just said retirement vehicles here, I think.
Yeah, I agree. And again, it's the situation dictates. So avoid, there you go. So you want to read that one?
Yeah, so if you're 70 and a half or older, right, you can take your RMDs and give them directly to a charity. So this money is not coming to you. So in your IRA, 401k, it's leaving there and going directly to the charity. And that method is called a qualified charitable deduction. And it's great because it doesn't even show up on your tax return.
Yes.
Right. Yeah. It's what we would call above the line, where you're not even paying taxes on that. So if you're charitably inclined and you're 70 and a half or older, would be a great way to put money, to give money to charities. Now, it's going to do multiple things. Your Medicare, how much you pay for Medicare will go down because that income is not included. It could also affect the amount of your Social Security that's taxed because that amount's not included, right? So you can have a multitude effect, is what I'm trying to say.
I don't think it would make your Medicare go down unless you're in the IRMA thing, but it certainly won't make it go up. That's it won't be subject to the IRMA rules, which is
So let me pull up the Medicare table, because I think that we can illustrate.
I got a sick child at home too, guys. So if you, I just typed in that if people are wondering why I'm looking away, is because I'm looking at old Pablo, because my sick child is home from school because he's sick. You know what I'm saying, Amar? Ooh, I'm so sick, I can't go to school. Actually, he did puke all over the place last night. So I gave him the benefit of the doubt. Younger Joshua said, oh, buddy. Oh, Pablo, you're on the, okay. Younger Joshua said, rub some dirt on a kid and go to school. But older Josh says, all right, I'll let you stay home.
So I got this from the Medicare website, right? So you can pull up the Medicare costs. And remember, it's based off 3 years past income. So this is based off your 2017 income, right? But let's say if you have, let's say you have about $85,000 of taxable income, and part of that is coming from your IRA and your charitable incline, you can get your income below 85, and then your Medicare for future years would drop as well.
Yeah.
So when I say that your Medicare premiums could potentially go down, it's if you're on the edge of one of these.
Yeah, I'm a huge fan of the QCDs. That's one of the best things Obama did for sure, is to solidify that to make it permanent. I'm a huge fan of that, absolutely. So, folks, and a lot of people, I'm surprised how many people aren't aware of that. But just remember, if you are at required minimum distribution, and it's not to take a distribution with a 1099 that goes to your AGI. That is not what we want to happen if we are going to ultimately have that money go to charity. It does not make sense to do that at all, from the Medicare premiums to the Social Security stuff to everything, especially if you're only taking the standard deduction. If you're only taking the standard deduction, you are not getting a charitable deduction. You're just not, because the standard deduction is too high. So if you're at 70.5, man, the qualified charitable distributions are freaking awesome for sure.
Yep.
Right. Hold off on mutual fund purposes. Yeah, I'm a big fan of that one, Amar.
Yeah. So do you want to explain this one?
So yeah, I did a video of that the other day. It's not to buy the dividend. One of the stupidest taxes you can pay is when you buy the dividend, and that just means or the capital gain, the distribution. So basically, I don't think I have the chart here anymore, but Vanguard Capital Opportunity Fund is getting ready to pay, I think it's like a 6.5% capital gain distribution. Healthcare is going to pay, when all said and done, about 12%, Vanguard Healthcare. So if you buy the fund in a taxable account now, from a pure dollar perspective, it doesn't matter in terms of if you buy the fund and what your net asset value is relative to buying the fund on the front end versus the taxable distribution. But that you will pay taxes on the distribution, even if you only bought the fund 2 days ago. So if they distribute $5,000 of taxable income to you, even though you just bought the fund, you are responsible for that $5,000 of taxable income, which you got to pay tax on. So buying the dividend is a big no-no. So if you say, I got $100,000, Josh, what should I do? I'm not telling you to put it into a fund that's getting ready to pay a big capital gain or dividend.
Yeah, and maybe let me ask you the opposite. Well, what if I have a mutual fund that I know is going to spit off a huge gain? Could I get out of it now? Does it matter?
No, that's the problem, because then you're probably gonna have a big capital gain in that too, and that's that's what I was gonna say. If you could bring up anything that shows if there's any indices or any asset class that's just got hammered this year, that would be the only thing. Because if you're up 35% from last year in the S&P 500 alone, it's hard to see that you're not going to pay capital gain by selling the fund. You know what I'm saying, Amar?
So let's go to.
Well, actually, real quick, can you bring up the Schwab have a thing of like the various indices and what their performance is year to date, or Fidelity?
So.
Well, don't share while you're looking, unless we.
Yeah, I don't have.
Okay.
So I have to log into my Fidelity and Schwab portal. So I'm not logged in.
Yeah, no big deal.
But I mean,
let's.
I'm just trying to see if I can find a quick indice, but.
Yeah, no worries. So everything is up. I don't know anything that's not up this year. Is oil and what's the oil and gas ETF? Because the price.
So I know MLPs are down, right? So master limited partnerships.
Are they all down, or is just some certain
across the board? Yeah, the indices are down quite a bit since 2016. So it's kind of gone up in like a bell shape.
Okay. So if you have some MLPs that are down, that's a great time to get the hell out of those things too, with the stupid K1s and everything. Oh, yeah. What's an oil and gas ETF? Anyone know, Amar? You got one that you follow?
I don't have one offhand that I follow. No,
that's fine. I just wondered, because the price of oil is taken. I just wonder if the oil and gas. All right, let's keep going. You can read the next one.
So, yeah, let's do the next one. So convert money from traditional IRA to Roth IRA. So probably the best time to do this is, if you're between 59.5 and 70.5, right? We have this window of opportunity. where we can take money from a traditional IRA, and if you're working and you start to transition to part-time work or you retire, your income's going to drop. Before you take Social Security, start paying some of those taxes up front, so we can do these conversions from traditional IRAs to Roth IRAs. So again, this would be based off of your tax situation. This you need to plan for. So you want to be at the higher end of a lower tax bracket. You don't want to convert your whole IRA and end up paying a lot of taxes and pushing yourself in the next tax bracket. But I personally recommend these conversions, before you had this opportunity to undo. So we would start in January, and then we would revisit it in November and December to see if we want to keep them. I would say this is the prime time between November and December to say, like, hey, where am I going to be? You know what your estimated income is.
Yeah.
You know what your estimated capital gains, interest, and dividends will look like. And then you can see how much room you have to convert from traditional to Roth.
Just real quick, I looked at the oil and gas ETFs, and UNG is down 20% year to date as of close of business yesterday, and that's the U.S. Natural Gas Fund. And then there's one other one, which is the Natural Gas Fund. There's another one that was down 19%, which was, I think, crude. I guess say just natural gas. So I guess that's pretty much it. Yeah, no, that's it. So if you have a natural gas holding specific, that's the only thing that's down that I can see from oil and natural gas. I don't know any other things that are down this year.
Look up like MLP index if you get a chance there. I think like one of them is like AM something MLP. But MLPs, if you own an MLP and you have the headaches of K1s and all that stuff, you could use those to take some losses.
That's something to look at. Absolutely. I mean, it's just there's not much out there for sure. So let's see. I'm looking at it. So yeah, keep harvesting your capital, just like we're talking about.
Yeah. So that's why I was saying this is if you can look up MLPs, I think they got to be down more than oil. Just how they're structured and for their tax efficiency that they still have business costs and stuff like that.
Well, here we go. So 4.5% or so, 6% on the infra cap MLP ETF. So Morgan Stanley, the Cushing MLP high income ETN. If you have an MLP, you're probably down. So that might be something you sell, but don't just do this blindly. Make sure it is down for sure. Yeah. But if there's no losses, there's nothing to harvest.
So that's capital losses, but also picking up capital gains, right? And I wanted to make sure that we talk about the wash sale rule, Josh.
Yeah.
In fact, I have a little thing here. Maybe this will help. So I'm just going to share a whiteboard. And I try to draw this out. So hopefully people that are watching just see this white screen now. Josh, do you see a white screen?
I do, yes, sir.
Yeah, so when you have a stock and it's going up and down like that, when you do tax loss harvesting, that means you bought it here and you're selling it here. And then if you wait 30 days, is it 30 days or 31 days for the wash rule?
I just say 31 because I can never remember, to be honest.
Yeah, so we'll say 31. I think it's after 30 days. So technically you can buy on the 31st day. You can buy it back, right? So if from here to here equals 31 days, you can buy it back. And so from accounting purposes, you've taken this loss from here to here to offset some income. But what you also have done is reset your basis down to here, right? So when we see tax loss harvesting, and if you have fluctuating income, you're going to want to bundle your losses for years that you have high income.
Yeah.
And for years that you have low income, you may want to pay some gains to get the basis up. And so let me share. So if you're a single filer, your long-term capital gains rate, start at 0 if your income is less than 40,000, goes to 15%, goes to 20%. There's also like Social Security surcharge. I think that's 3.8% if you're in the higher tax brackets.
Right. Mm-hmm.
So here is what I want to really kind of emphasize on this part is that you could have a stock that goes from 10 to 20 over, let's just say 10 years. But your personal tax bracket between this period could fluctuate. Sometimes you could be at 15% capital gains. Sometimes you could be at 20. And then on the income side, you could be, 30%, 32% federal, 24. Sometimes you could be at 12, right? So when you go from 10 to 20, you kind of want to compartmentalize, different step ups in value, right? And where you pay taxes. And so when paying capital gains really means is that if you're in a low tax bracket, it may make sense to pay those capital gains rates.
Yep.
Even if you're going to keep that stock, right? You can, and if it's less than 31 days, it just can't be substantially equal, right? So you can go from like, and I'm just using S&P dividend to NASDAQ. And then as long as 70% are not in both of these, that doesn't trigger a wash sale rule. So here you would work with the CPA. They have these accounting programs that can say, are they substantially similar or not? So I'm going to go back to
the issue that I think a lot of advisors don't do is they don't advise on tax loss harvesting if there isn't any losses. And I think you can still do the specific identification, which means you can. So I was working with a guy last week, and he's trying to redo his portfolio a little bit. And we're like, look, you can identify the specific lots of shares that you bought. So if you bought shares at 100 shares in December 1st, 1994, 100 shares December 1st, 1925, whatever, you can identify those and take the gains or whatever it is. You can absolutely.
Yeah, and that's a key thing to point out, because if you just work with like a big firm, they're going to use average cost basis.
Exactly.
Right. And that's not really doing. If you want to be as efficient as possible, you need to get down to the lot level.
Exactly.
And getting down to the lot level requires, a little bit of extra work. So just like you said, you got to make sure your advisor knows which, not to look at the whole position, but to look at the lots to see, are there any losses between lots? And if you dollar cost average into a security, I guarantee you're going to have lots with losses.
Yeah, absolutely.
I mean, that's almost like expected.
Which goes a lot into the qualifying, picking up capital gains if you're in a low tax bracket. I cannot stress this enough. And I'm telling you right now, remember, taxable income is not the same as AGI. And so if you have taxable income of $50,000, all right, that's after your standard deduction, or for the few that itemize, that's after itemizations. That is what your tax bracket is based on. And so if you have $50,000 and you have some gains on the table, why not sell those suckers? If you're married, filing jointly, take $25,000 off the table. It's tax-free because you're still in the 12% tax bracket. Just get that done, because if you don't, you're losing the opportunity to take some gains off the table. If you want, I'm not saying you should do it just because they're low capital gains. There might be another reason to keep the shares, but man, people blow this all the time. In fact, Amar, I had I'll never forget, it pissed me off. This is when I knew I had to go in my own business. She was up in Maine, I think, and she had negative income for years, like 3 straight years, because she has these rental properties and stuff like that. And she was getting ready to take RMDs. And I was so freaking pissed off. I was like, you've had negative income for all these years. You could have been pulling money. I had to say this because
can't change the past, dude.
Well, I didn't want to also say,
your CPA is not doing a good job, right? I mean,
that's ultimately what it is. I said, but you could have been taking money out of these IRAs, essentially tax-free, because you had negative income, and that didn't happen. And anyway, the long story short was, now that she was at RMD, she had significant IRAs, and she was a widow now. Her husband just passed like a year before, and the tax bomb, the widow's tax trap.
And that's a good thing to bring up, Josh, is that like a lot of these is not just one as a silo. You could do multiple of these together. Like you could donate to a charity.
Yep.
By RMD.
Yep.
You could also, obviously hold off on purchase, but let me give another one. Let's say you donate via donor advised fund. At that same time, you can do a Roth IRA to Roth conversion to kind of even out the taxes, right? The goal is not to pay. Well, if you talk to a CPA, the goal is to pay the least amount of tax possible. But if you talk to an advisor, the goal is to not pay more taxes.
Exactly.
Over a period of time. And so let's go to this next one, Qualified Opportunity Fund. And I have this great article that I want to just bring up just because it has this graph here, or this chart. So basically, opportunity zone funds, right? There's this website, I'm drawing a blank, but you can find opportunity zones. There are mutual funds, there's private placements that invest in these. And basically, if you have a large capital gain, what the government's saying is that take some of that money, invest in the opportunity zone. So these are areas that need economic help. And those areas, because you made an investment, we're going to defer your capital gains tax. And we're going to also, if you hold it for 5 and 7 years, give you a step up in your basis. So you can get an increase in your basis, which reduces the amount of capital gains that you have to pay. So this kind of gives you a good outline. You invest, let's say November 1st of 2018, you hold it for 5 years, there's a 10% basis increase. You hold it for another 2 years, there's another 5%, and then you can get another amount here once your mandatory deferral gain is recognized. And so you could potentially have a tax-free withdrawal of the gains after you invest. You still have that capital gains piece, but that basis has grown and you've deferred it. And I shouldn't take credit for this. Wells Fargo put out this article. It's pretty good in my opinion.
Yeah.
Goes over, here's the website
Cool.
where you can find zones. And I'm telling you, I live in.
Click on that. Let's see. Does it show us the? Click on that real quick, Amar. You got a couple. Just while you're doing that, we've had a couple of people subscribe to your channel. So don't forget, folks, if you're new to watching since we started, if you could subscribe to Amar's YouTube channel, because once he gets 100 people on there, he can actually get his own private, URL, youtube.com/ what, Savvy Wealth? Is that what are you going to call it?
Savvy Wealth Advice.
Savvy Wealth Advice. So if you get a chance, and we'll put the link in the show notes here, but just real quick, Amar is a friend of mine. I like Amar. I like the work he's doing. So that would help me out by helping Amar out, just because it's quid pro quo. When I get Amar, he sends me lots of kind thoughts and prayers.
So I guess I can't open this because I don't have Adobe Flash on this, but if you click on this link right here for a map of all designated qualified. So basically what I was going to say, Josh, is that in my zip code, there's a brand new Sprouts, and right across on that same street is an opportunity zone.
Really?
And so like, you got to be thinking, when I think economic development, I'm thinking of struggling areas.
Right.
This was based off of census data a while back, right? So there's this huge delay. And so you can find zones that are.
So there's an opportunity zone next to Sprouts, and Sprouts doesn't open up in decrepit places. They're opening up in hipster kind of places.
Yeah, it's a brand new Sprouts. It's nice.
That's crazy.
Yeah. So I'm just saying that, like, when you look at these, don't go off of like, hey, there's going to be default risks. There's going to be, I mean, obviously there is some of those type of risks, but you can find zones or neighborhoods that could be in your backyard where you actually have some personal knowledge. Like, I mean, I could hit a golf ball. If I had a flat roof, I could hit a golf ball to an opportunity zone from where I live. And I just think that's crazy.
How do you invest in REITs or something like that? Or how do you
so most of these are REITs. I mean, you can invest in businesses as well. You can do it through mutual funds. You can also do it through private placements to get into some of these. But yeah, I mean, there's multiple ways. Again, you can work with a tax advisor, but you can go through this and they have what you need to do to qualify, or what investment qualifies as an opportunity zone. So
that's crazy, man. That's fantastic. All right. Yeah. So if I'm looking at this website now, and I'll just go ahead and put in the show notes right now, and they have a list of opportunity. I'm typing. You keep going, Amar. I'm just typing into the comments.
So one thing that I hear about all the time, I didn't spend all my money in my flexible savings account.
Yes.
And that's just, you lose that money if you don't. I mean, that money goes back to the employer, but you personally have lost the ability to spend that money. And so I would say that you should look at, do you need any refills or prescriptions? Do you need, I mean, I got orthotics. My feet were killing me. So in the beginning of the year, the doctor wanted me to buy these $600 orthotics. I said, no way. End of the year, I have some extra money. I'm going to give it a shot. And
well, it'd be crazy not to.
Yeah. And, I've had people get glasses, or if you have glasses, get contacts. I mean, there's tons of stuff that you could get to make sure you use those dollar amounts. Bunching up charitable deductions.
We're not seeing go back to the article. We're still seeing the opportunity zone thing.
Oh, oops.
Dude, I'm just looking at the designated qualified communities. Like in Phoenix, Maricopa County, there's a ton of different places in Maricopa County and Phoenix. Baldwin County, wherever that is in Alabama. Dude, it's crazy. There's tons of the California. Yeah, look at that. That's freaking nuts, dude. That is nuts. I don't know how you do this, but that is nuts. If you can do this through a real estate investment trust, I just wondered if they did it through a real estate investment trust, would you still get the benefits? I mean, you'd have to, right? I mean,
yeah. So you still get the flow through of income and everything else. Remember, there's a difference between income and capital gains, right?
Right.
So when you sell that REIT, you're still going to have the capital gains from the basis that you had from your previous investment.
Right. Gotcha.
You're getting a step up, 10% after 5 years, another 5% after 2 years. So 7 years to get 15% step up. But it is, I mean, we can link to that Wells Fargo article too. It's a pretty good article.
Great.
So we have about 6 or 7 minutes here. So I want to make sure that we get through 9 and 10 and then have some conversation about maybe multiple of these together. So bunching up charitable contributions. If you're in retirement, or even if you're not in retirement, look at donor advised funds. I mean, this is a great opportunity while you're in a high income bracket to kind of lump some charitable giving. So I'll give you an example. I had a client that sold a business. In that time that they sold the business, we knew that their income was going to go really high. So with some of these donor advised funds, you could gift shares of the business prior to sale into the donor advised fund. Fidelity, Schwab, they'll hold it. You sell the business, all that gain is now in the donor advised fund, and you're not paying taxes on it. So it's an amazing opportunity to lump sum, especially with the standard deductions being so high. I think more people are going to start looking at donor advised funds for the gifting. And
makes sense. Absolutely.
One thing I love about it personally is that you don't have to chase around all these charities to make sure you get the letters that you gifted money. I mean, you're only getting one letter, and that's coming from an institution, and then you get to decide when to give the money out.
Dude, I'm just still amazed how many opportunity zones there are. I'm just looking at that spreadsheet that was through It's crazy. So I'm looking at Fulton County where I'm at, and there's just tons in Fulton County because that's North Fulton County is the wealthy part of the county. South Fulton County is the is a hurting for sure. And I mean, you could literally go down there and see, like you were saying about, swinging a golf thing, whatever. That's yeah, that's
But
interesting.
what I'm saying is, if you look at that census data, it's old. It's based off of old data. Is what I'm saying.
2011 to 2015 tomorrow is what it says.
Yeah.
So
So
that's
like
going
there
10
are some
years old.
areas between 2012 to 2019 that have significantly changed.
Yeah, absolutely.
And they could be up and coming areas where it may not be as risky as you're thinking when you just say opportunity zone, economic development zone.
I 100% agree. Absolutely. All right.
The last thing I want to make sure that we hit on is we're not tax advisors. Josh and I don't do taxes for people. I mean, we do proactive planning, like looking into the future, but we can't tell you where to take deductions and so forth. So the best time to meet with your tax advisor is now, because you have some year-end ideas.
Yes. Yep.
If you want to do anything between now and the end of the year, you have the opportunity. If you meet with your CPA in March or April, you can't do stuff for 2019, because whatever you do, besides retirement contributions, will be for 2020.
And my wife works at a CPA firm, and they got downtime right now. I'm just telling you. So the extension blast from middle of September through the end of October is crazy. The time, obviously, from March to the middle of April is crazy, but right now it's downtime. There's really no reason not to call your tax guy and say, hey, I want to have a discussion about what I need to be doing by the end of the year. There's none, because a lot of these tax firms are not, their downtime is right now. And if you wait till March 30th to do that, you're gonna have to take a number for sure.
Yeah. And some of the opportunities, like putting into a donor advised fund, won't count for 2019. It'll count for 2020, and you've lost your opportunity. So yeah, definitely talk with tax professionals of what should I be doing today, based off of this is the income, this is where we're going to be. Should I take some capital gains because I'm in a low tax bracket? Should I take some capital losses because I'm in a high tax bracket? And go from there.
Or just like you said, take some look at charitable. I mean, however you want to do it, for sure. I want to go back about QCDs, qualified charitable distributions, too, real quick, Amar. I think a lot of people overlook the fact that when you're giving money, all right, is out of your estate. And like if you live in a place like Massachusetts, someone jumped on here from I forgot, but someplace in Massachusetts, there isn't a significant estate tax for the Commonwealth of Massachusetts. Does California have an estate tax?
No, it's probably coming, but we don't. Yeah. So like Washington, Massachusetts, there's an estate tax.
And so in Massachusetts, the exemption is $1 million. Once you go above the $1 million threshold, you start from scratch as if you didn't have that $1 million. It's freaking insane. And we're talking a estate tax as high as 16, I think it's 16.4% or something like that. The best thing about giving assets away, there's a number one thing, but the first thing is it gets it out of your estate. So that will not be part of your asset base when it comes time to pay the estate tax. Part two is it gets the growth out of your estate. And so I hear this all the time, I'll wait till I'm dead before I give my kids my money. And I'm like, but then they'll be 65 years old. I mean, if they're struggling now with, husband and wife and kids, and they're struggling and you have enough to live on, and you want to give it to them to see how they do it, give them freaking $50,000. There's no gift tax unless we're talking millions of dollars. Just go ahead and give it to them. Not only can they use the money, you can see how they do it, but it gets that $50,000 out of your estate, and it gets the growth of that $50,000 out of your estate as well. And I can't tell you, Amar, how many people I've talked to are like 80 years old. They're starting a gifting strategy, and their kids by then are, they'll take the money, but they're well, okay. They're fine. They could have given it to them earlier to avoid a lot of struggles. You know what I'm saying?
Yeah. So the important part is to have conversations with your family. If you gift early, then you can see what actually happens to that money. But for states that have a state estate tax, and another strategy is using what's called a SLAT, which is spousal lifetime annuity trust. Because the exemption amounts are so high, you can use to carve out some pieces of your estate for your spouse to have lifetime access to, but you can also get the growth out that way as well. So I want to say there's layers to estate planning for those specific states. And there's layers to different family dynamics, right? Like if you give a child $50,000 and they show up with like a red Corvette,
Yeah, exactly.
then you know that you may want to put some restrictions on future dollars if that's not within your value set, right?
All right, so let's. No, I agree. I agree with that 100%. So let's unshare the screen. What are you working on, Amar, with your clients going to the year end? Anything jumping out at you that you got up your sleeve that is paying the big bucks?
So we're creating reports right now that show realized gains throughout the year and unrealized gains, and at the lot level, so that way we can specify, hey, here are some opportunities for year-end tax planning. And I think that's a big piece of just dialing everything in. When it comes to investments, we're trying to have a conversation about what, downside risk are you comfortable with?
That's
sure that we're aligned with that. And, gifting, we come to the charitable part of the season. So, if you have high income this year, maybe doing 2 to 3 years worth of gifts all at once into a donor advised fund makes sense. So you can get that larger deduction now, itemize.
Are you taking gains off the table to avoid
gains off the, I mean, if you're in a lower tax bracket, paying some capital gains to raise that cost basis makes sense as well. And so, we're looking at several things from that perspective. But I think the most important thing is to have a conversation, right? If you're not having conversations about what you should be doing, next year is going to be too late.
Yeah,
you missed the boat.
This opportunity zone thing is pretty interesting to me. My wife attended some CPA or CPE, what they call for tax people. She was down there in Sandy Springs yesterday, and she brought this book of this home, and she's all telling me about it. I was like, I just want to jump off a bridge because it's so freaking boring. But one of the things she was talking about, but what my wife talks about is not boring, Amar, because she's so pretty. I was like, you keep talking. And she's like, you're not even listening, Josh. I said, no, I am. Were you talking about the Patriots and touchdown Tommy? But she was getting excited about the opportunity zone thing. And anyway, I just came across this while you were yapping. This is from, I'll put a link in the show notes, Opportunity Zone Fund Directory. This is interesting to me. Here's an Alpha Opportunity Zone Fund 1, American Opportunity Zone. I have no idea what the Bay Area Opportunity Zone. I just think
you got to be careful with some of these. So some of these, what happens is that there's these private equity firms that own the fund. And then, so they have their fee structure, and then they hire a real estate company locally to actually buy and manage the property. I would say there's going direct through either a mutual fund or private placement. You're going to save a ton of money because you don't have that layered fee effect, number one. And number two, you have boots on the ground, so like the people that are actually taking your funds are the ones actually buying the properties and stuff like that if you go through a fund. But you could also qualify, like we can pull up like Redfin or something, and you can find like a real estate piece that you could buy directly and still qualify for the opportunities. Right. You don't have to work with these large institutional players. You can do some of this yourself.
Well, here's one called, we're not making a recommendation. I'm just literally looking at it. It says TPP Capital Management in Pennsylvania, affordable housing, commercial real estate, community revitalization, blah, blah, blah. And they just give a bunch of different things. It's interesting to look at. I'm not saying you should, I don't know the first thing, but this has a $300 million fund size. And I don't know the first thing about it. I really don't care to know about it, but it's interesting to me. And, with that, let me just, we all get negative on gentrification and things of that nature, but it happens. All right. So we know for a fact gentrification happens. We know for a fact poor people get put out. We know for a fact eminent domain happens. One of my huge negatives on the Trumpsters is appreciation of eminent domain, which I can't stand. But Be it as it may, the facts are these things are legit. They happen, and somebody is taking advantage of that. And so the issue is, if someone's taking advantage of it and they're doing it in a tax efficient way, maybe that could be you. I don't know. I don't know how this would work. You'd have to do your due diligence, your research. But I'm not talking to you, Amar. I'm talking to the audience as a whole. If you just did probably 2 weeks of investigation, I bet you would know more than freaking 98% of people out there with just a couple weeks of investigation. Just because no one's talking about this, and yet it might be, a fraud, might be a fake, but it might be something that really takes hold for a long, long time to come. I don't know, but it's interesting. All right, so we've been up for an hour here, Amar. Let's see if we got any other questions here. No, we got some people, looks like, jumping off. So we plan on doing this. I vacillate between every week or every 2 weeks. Every week just seems a little bit of a time crunch, frankly. But then again, every 2 weeks is easy to overlook it. So Savvy Wealth Advice is Amar's his YouTube channel. So if you could subscribe there, and are you gonna put this up on your YouTube channel too, Amar?
Yeah, well, you're gonna send me the video, right?
Yeah, you're right on.
Yeah,
he's got a podcast too, which you can get on all your various Apple and the whole thing.
Yeah.
Is next week Thanksgiving or is the week after that? I can't remember.
No, next week's Thanksgiving.
Next week is?
Yeah.
Okay, so we probably won't be doing this next week. So 2 weeks time, we'll do it again. How's that sound?
I think that's good.
So if you guys, just in the comments, if you guys like every week or every 2 weeks, let me know. I still do my thing on Sunday at 7:30, but if you like Amar and I to do this every week or every two, it'd be interesting to hear what you say.
Yeah.
Any last words, Amar, for the group here?
No, this is fun.
Yeah, I enjoy it very much. So thanks, guys, and we'll see you all next time. Thanks now.
Yep. Bye.